Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for August 2024. This is our disclaimer. Please read it at your leisure. To move forward, I will take it as read. So the portfolio for August basically fell in line with the market, or actually a little bit more than the market. Essentially, the same dynamics which have been weighing on performance continue to weigh on the portfolio in August, and as you can see, for the last 6 months, largely from the start of the second quarter 2024, the portfolio has underperformed the market, being relatively flat with the market up around 6%. I'd just like to note that we are now using a new index, the MSCI All Country World Index Net. We've changed the indices simply because we can get better data, better access to data with this index. Also, it's the index that's used more by peer managers. And we also found with the previous index where we were sourcing it from a third party that some of the data we were getting was incorrect. I guess it's important to note that the portfolio continues to deliver to its objective to outperform its 5-year investment horizon, a rolling investment horizon, which it has done. But as you can see, the alpha has reduced over the last couple of quarters. Here, the performance is shown graphically in a cumulative sense. Obviously, Adansonia is the blue line, running at 15% per annum since inception versus the market 13.4% per annum. This relative underperformance largely started from the end of the first quarter, start of the second quarter 2024, where the cumulative performance for Adansonia peaked at 130% on the chart. You can see there that the break between ourselves and the market at that point in time was the largest. And since then, you've seen some of the performance start to converge, or the two lines have converged a little bit. I just want to spend a little bit of time talking about this because while we're not happy about it, we're not too worried about it. So effectively, as I mentioned before, the relative performance between the portfolio and the index has dragged from the second quarter of 24. And I've mentioned it before in several updates, but it's due largely to the breadth of, or this very narrow breadth of stocks, which are essentially driving the market forward. And we've got several large mega cap stocks, Nvidia, Apple, Tesla, and Broadcom, which are rallying strongly on the AI theme, which aren't owned by the portfolio for valuation reasons. Also, we've seen over this period of time, unfortunately, two of our stocks, Louis Vuitton and Porsche, which are Euro-listed, being sold down irrationally on fears of a weaker Chinese consumer, and that's not right. It's not just a Chinese story for these stocks, and I'll talk about LVMH as our feature stock in a few slides. Anyway, just to put this index performance versus the market into some context, from the end of the first quarter 2024, or March 24, to the 31st of August 2024, the index is up 7% or 7.2% in US dollar terms over this period. Now, Apple, which is the largest index constituent over these 5 months, is up 33.5%. Nvidia, which is the second largest constituent of this index, is up 32%. Broadcom, the 10th largest, is up 23%, and Tesla is up 22%. As I mentioned before, the portfolio does not own any of these shares due to valuation reasons, and unfortunately, mathematically, it's very hard to outperform the index when these large constituents are basically outperforming the index by a multiple of 3 or 4 times. However, in saying that, we're seeing some of this performance starting to normalize, and we're staying true to our fundamental approach. And we will not purchase expensive equities which are running on strong momentum. And just to give you some idea about this, Nvidia is trading on a calendar year 25 EV/EBITDA of 25 times, Apple 24 times. These are just crazy numbers. This is more than 20% over what Microsoft is trading at. Tesla, which is on a PE of 75 times for calendar 25, is trading on a EV/EBITDA for that year of 44 times. We just can't justify buying these shares. Anyway, that is largely the reason for the relative performance over the last couple of quarters. As I said, we basically see that this hopefully is starting to normalize a little bit, and we will not essentially buy hot stocks that are running on momentum that are priced ridiculously. Anyway, as I mentioned, LVMH is one share that we've owned, which has performed poorly over this period or from the second quarter of this year. Spoken about this share before, so shouldn't be a surprise. But very quickly, it's a house of 75 luxury brands across 5 segments, which are selling in over 4,500 stores across 70 countries. Essentially, these brands are well known and premium brands. The key drivers here, well, the key driver for the shares or for the earnings, that it's driven by growing global middle class and women comprising a growing percentage of the workforce. High-end brands face fewer competitors. They command strong customer loyalty and have lower economic sensitivity. In other words, essentially, if you can afford to buy a $2,500 purse or a $4,000 handbag, you're not going to be too worried if a loaf of bread goes up by 20 cents. Also, the company is in control of all of its distribution. There's no discounting. It commands strong gross sales margins, and essentially, it has fallen actually fell below 600 euros a share, where we valued the stock at about 860 euro a share. So as I said, over this period of time, from March to August, the stock was down over 19% in local currency terms on the fear of a weaker Chinese consumer. While obviously higher inflation, higher interest rates, cost of living pressures, does have an impact and a bearing on the consumer. It's not just a China story, and as I mentioned before, it has relatively lower economic sensitivity. So when you actually drill down into the facts of the story, the China only accounts for 7% of total revenue. The latest results for the stock basically saw that that revenue was a little bit weaker than consensus. The first quarter sales and revenue revenue was down 1.3% below market estimates, and on this second quarter earnings call, total revenue was 2.6% below consensus estimates. So obviously not positive results, but essentially not results where we believe the stock should be down over 19%. And at the time that the call was made, the prevailing share price had priced in a lot of this bad news, and basically we were seeing the share as compelling value. In saying that, it did sell off on cost of living pressures, obviously, and also the Chinese market at the moment, the housing sector there is going through some real turmoil, and the Chinese consumer has become a little bit absent. But in saying that, consumers from India, which is also around 7% of total revenue, have rebounded very strongly year on year. So it's not just a China story in isolation. In saying that, we have recently had stimulus measures announced from China, and it's seen a rebound in these shares, and effectively, I mean, LVMH itself overnight was up just under 10% on the 26th of September. So the stock is coming back strongly, and hopefully we will hopefully start to see some normalization of that weakness, and that the share price should be trading where it is. Anyway, that's the end of the update. As before, Tony and I are always available for a call. Our contact details are on this page, or otherwise you can contact us by the inquiries line on the Adansonia website. Anyway, until next month, we hope that you stay well. Okay, thank you very much. Bye.